All right. I'm a stickler for being on time. So thank you for joining this afternoon. I'm Orest Tomaselli. I'm the president of project review at CondoTek. And today's webinar is going to be about our new lending compliance report. This has been something that has been in the works for a very long time. We are really proud of the product that we were able to produce. And I have to tell you, this has been asked for over and over and over again by property managers, by board members across the United States, asking for some sort of information on whether or not their particular condo or co-op properties are compliant with residential lending guidelines. As always, you can ask any question you like in the chat, and we will try to get to answer it before the end of the presentation. But again, this is a 30-minute webinar. Hopefully we'll have a little bit of time at the end for some questions. If we don't get to the questions, we always respond to you with the answer you ask. So without any further ado, lending compliance. So there are new Fannie Mae, Freddie Mac, and portfolio lending requirements in the industry. We're all pretty much aware of what's going on, but I'm going to give you a little bit of a recap. There is a focus on property condition, critical repairs that haven't been performed within some of these condo or co-op properties, reserves, violations if they're tied to some sort of critical repair or mechanical component or structural component in the building. And the big one these days, property insurance, HOAs insurance policies. We're seeing across the industry that residential, local banks and national banks are issuing reciprocal denials based upon whether or not a property complies and whether or not a property is in or on or receives an unavailable designation from Fannie Mae or Freddie Mac. That's a new little wrinkle, and that's something that's been kind of building over the last year or so. It's impacting thousands of condominium developments and cooperative developments across the country, where we'll see a property be unavailable for mortgage financing. Other lenders are unwilling to lend within that property. Mortgage financing is almost completely unavailable in that property for purchasers and owners, and it's a giant issue in the industry right now. Yeah, the issue is that, boards and property managers, since these are relatively new guidelines for lending, issued within the last year or so, haven't been able to really get their buildings compliant. And many associations don't even know that they're not compliant with the new lending guidelines. And they find out often either when Freddie Mac now informs them that their property is unavailable for lending, or if a purchaser or a borrower goes in for a refinance or a purchase mortgage and they're denied. So the most common reasons for denial are, again, non-compliant operating budget. If you don't have reserves in the operating budget or don't have the appropriate reserves in an operating budget so that they're collected every single year within maintenance cost. Limited amassed reserves. We see lots of buildings across the United States that don't have a lot of capital sitting in a reserve account. A lot of these buildings in some of the largest cities operate via special assessment, and that's technically not compliant right now. It depends on whether or not the association is in good condition or not, but limited amassed reserves is a major red flag for lending compliance right now. The big one, property insurance deductibles and coverage. We're finding that as a result of the increase in cost for insurance policies and condo and co-op boards making changes to their insurance policies, specifically regarding their deductibles and new lending guidelines, that insurance policies aren't compliant with residential lending guidelines. We're seeing that if they're utilizing reserve studies, if associations have obtained a reserve study, that they're either A, not following it, or B, it's expired, because reserve studies have a shelf life of essentially 3 years now. And the other major reason is that, we see special assessments for, repairs that have to be performed, that aren't complete. They're not funded. They don't, some associations don't have that capital sitting in their accounts. So there's some challenges that come out of this, right? Condo and co-op buildings are really under extreme scrutiny by agencies and lenders. In the last 2 decades that I've been in residential condo and co-op mortgage compliance, I've never seen the level of scrutiny that currently exists for a loan to be performed on a condo or co-op building, or within a condo co-op building for a residential mortgage. All of these compliance guidelines are really driven by agency lending guidelines. So that means that even though a building may have maybe a luxury building and may have jumbo mortgage financing that's offered on a regular basis because the loan amounts are so high in that building, that all boils down to whether or not, lending in that building or available lending in that building now boils down to whether or not that building is compliant with these Fannie Mae and Freddie Mac agency lending guidelines. So we're seeing a bunch of rejections across the industry for buildings that, are super jumbo loans that just do not comply with these new requirements. And I think that's a testament to the fact that these are good requirements and good risk evaluations for these buildings. You know, we're fortunately in a place, I don't personally suffer from a loss when, a building isn't compliant, but several lenders have suffered major losses as a result of, repurchases required for closing loans in buildings that aren't compliant. So we're seeing that happen across the industry as well. We're getting calls from lenders saying we really want to use your services because we've seen, we have 18 repurchases this month on condo loans that we've closed with agency lending guidelines. And, my jaw drops sometimes because even though some lenders have large condo and co-op review departments, the guidelines are such right now that, if you're off just by a little bit, sometimes that it would make your specific loan ineligible to be purchased by the agencies. This is something that's going on for both national and local banks. So, national large big box lenders are of course enforcing these guidelines, but we're seeing that local banks that have typically provided loans to new construction condominium developments or provided loans within their portfolio that are a little outside the box, local banks are also complying with these new lending guidelines. And that, of course, means that a lot of buildings just aren't compliant right now. We're also seeing a really interesting challenge for a lot of condominium and cooperative buildings, which is insurance carriers are increasing premiums by dramatic percentages. We're seeing increases of 30%, 80%. In one building, we saw an increase of premium of 300% year over year based upon the condo property, in this instance, being non-compliant with residential lending guidelines. They had no reserves. They had, critical repairs that weren't complete. So those are the challenges that are out there in the industry getting lending in condominium cooperative development. So this is kind of all bubbling up right now where we're seeing unit sales, at risk, right? If a purchaser has signed a contract and can't get mortgage financing and needs mortgage financing in order to close a transaction, and that building is non-warrantable, we're seeing that there, in a lot of canceled contracts, a lot of people essentially pulling out of contracts because they don't want to buy in that specific building. Unit values are starting to come down based upon, the fact that a building is compliant or non-compliant. So if a building is non-compliant, we've seen a couple of instances now in the Midwest where a building, a unit value is dropped by, 15, 20% because the building's totally non-warrantable for lending. A lot of buyers are forced into these last minute subpar loan products where, they signed a contract and and went out to get a mortgage pre-approval that was given to them at market interest rates, and now all of a sudden, in order to close that specific loan, they're paying 1.5 or 2% higher in an interest rate because the building isn't compliant. Again, we're seeing condo and co-op loan rejections, rampant across the industry, more so than we've ever seen before. And what we see is that there's really a lack of accurate guidance for property managers and boards. I hear information every single day that's inaccurate, that's, coming from a board member or a property manager says, well, we're compliant this way. And when we look at the building, like, no, you're not. And the new, those are guidelines from 3 years ago or 5 years ago that you're trying to be compliant with. The market has shifted and the market has changed. And what we're seeing mostly is, that boards don't have, and property managers don't even have the time to align these properties with these new requirements. I mean, it's time consuming. In some instances, maybe they're rare, but in some instances, you have to make changes to the bylaws in order for a building to become compliant. In some instances, you have to complete repairs to the entire building or complete a structural repair for the building to become compliant. And dependent upon the state or municipality or city that the building is in, sometimes it takes a really long time to get sign off on a CO or to actually get a permit to do the work that's necessary in that particular building. So that's kind of what's happening in the industry right now. So what we came up with at CondoTek is, our version of the best way for an association property manager essentially to get direction about whether or not their particular property is compliant for lending. And we call it the lender compliance report. We provide an individual analysis for each unique property, right? There is no like cookie cutter situation in almost any condo or co-op development. Each one has to be individually analyzed. Detailed analysis of operational governance, whether or not that's compliant with agency lending guidelines and or portfolio lending guidelines. A full property insurance policy analysis is provided within this report. Now, we're seeing most rejections come because of, a misalignment of the insurance policy with agency or, lender guidelines. That is one of the most valuable pieces of this lender compliance report. A complete reserve account analysis. Do you have enough money in the reserve account? Have you been contributing enough money into the reserve account? Looking at your operating budget to see what your year-over-year contribution has been. A review of every engineering or reserve study report within the last 3 years that's been performed on the building to make sure that there are no red flags regarding structural condition, mechanical condition, and how that relates to how associations are paying for those repairs and maintenance, whether that's through a special assessment, and whether or not that special assessment is compliant with agency and bank lending guidelines. We do a complete critical repair review based upon the information we get, determining whether or not there's a critical repair that's necessary on the property right now, obviously through reviewing the engineering reports and reserve study reports and questionnaire we receive. And we do an analysis of the condo co-op financials should they be available. So cooperative lending is driven by an analysis of the financials on the property. And in some instances, condo financials are very telling as well. And we can tell whether or not there's an issue on a particular property. And so we review all of this information, that lender questionnaire, certificate of insurance, anything on the property regarding litigation, flood insurance policies, financials, we review the budget, we review the governing documents on the property. And what we come up with is a detailed compliance determination on the property. And it's a pass-fail outline of compliance, which our current lender clients love, right? It lets you know what's compliant about the property, what's not. It's a determination of agency and portfolio lender compliance or acceptance. It's a per issue compliance recommendation. So you can kind of drill down on what specifically is wrong about that property, if anything is wrong, if it's non-compliant. and we make a recommendation to how to fix that specific issue. And that recommendation comes from some of the most seasoned and experienced reviewers of condominium and cooperative mortgage financing and mortgage policy in the country. We provide a reviewed, document expiration because documents expire regularly, whether it's 90 days or 120 days based upon the review. And most importantly, provide this step-by-step compliance roadmap. So we don't just tell you what's wrong with the property or tell you the issue that is causing a problem in the particular property, but we tell you how to fix it. And that's invaluable. That's something that we haven't found anywhere in the industry being provided to property managers or boards or attorneys or even realtors, sales agents or listing agents or purchasers directly. There is a step-by-step compliance roadmap provided in every single lending compliance report we put out. It's fantastic. The way we like to do this, you can order a lending compliance report as a single instance, essentially, and understand what's going on with the property. We charge a fee of $995 to provide that lending compliance report for that property, for that particular property. But there's expirations of specific documents that happen every 90 days. So what we decided to come up with is a subscription model should a board or property management group want to put their particular condo or cooperative association into a process of ongoing compliance verification. And initial, questions and interviews that we've done with some of the largest property managers across the country, they said that they would much rather a compliance subscription, essentially, so they always know whether a property is in compliance with residential lending guidelines or not. We update the property if you're in that subscription program with the issue resolution. So if something has changed, if you've fixed a problem, we update our determination. The compliance essentially for lending goes on in perpetuity, where essentially you'll have compliance on a particular project forever and lending compliance forever. And we're really, thoroughly satisfied with the cost that, we're for the association. We really pulled an enormous amount of associations across the country and doing this at the most rock bottom price we can for this type and level of compliance that we're providing to these associations. It's important to note that we have a bunch of, partners and industry, we're partnered at CondoTek with industry giants, right? So in the New York market, we're partnered with Board Packager, where Board Packager clients can actually have this ongoing compliance report and this lender compliance package available in Board Packager for resale to lenders, for resale to purchasers or attorneys, and it's constantly updated. So that's something that we're really proud of, especially since Board Packager is so prominent within the industry in the New York State market or New York City marketplace. And we're also partnered with MGIC. MGIC is one of the largest mortgage insurance companies across in the country. And when we provide one of our condo project warrant reviews, essentially that review, if it is a compliant project, is automatically accepted for mortgage insurance through MGIC. We have a bunch of available property manager guidance and training should property managers want to get some information about this product or program. We like to train entire offices. We do that pretty regularly as well. And we provide this bundle analysis for entire managed portfolios for property manager groups should they require or request it. And we're in the middle of a couple of them right now. The good news here is that I think for the industry, we're seeing that a lot of this information hasn't been available. And I think the goal at the end of the day is to have very compliant condominium and cooperative developments that have access to residential mortgage financing, whether it's conforming loan amounts or jumbo mortgage amounts, that they have access to this in an abundant way, right? That lots of lenders can provide mortgage financing in a particular property because they are compliant. So we make this relatively easy. To place an order for a lending compliance report, all you have to do is email sales@condotek.com, and one of the team members will respond to you with the requirements and get you to the point where you can place an order. That is not only for the individual order, but also for the subscription if you want to subscribe for an ongoing compliance review. Again, we do this everywhere in the country. We're nationwide. Most of our report that is provided is technology driven. It's really expert guidance, and it's kind of one of the most efficient ways to get a condominium property approved or a cooperative property approved or on the road to lending compliance that's available in the industry right now. Outside of that, we always like to kind of give you a little bit of information about what's coming. The insurance issue, as I outlined, has been one of the biggest issues in the industry, determining whether or not a building is compliant or not compliant for residential mortgage financing, especially their new insurance policies and specifically regarding the deductibles and whether or not the insurance policy meets agency requirements. And we decided to put together our team of experts to make them available for our industry partners. And we are running a pretty interesting webinar on March 27th. Everything you need to know about condo insurance and what's compliant, what's not compliant, how to align your particular insurance policy with agency and lender compliance requirements. So save that date. We will provide everybody who joined this presentation today with a recording of this presentation, as well as the answers to any questions that have been asked. I don't think we have any questions right now, but should you have a question in the future, please don't hesitate to email us or email the sales team. So thank you very much in aligning with our current guidelines, essentially of timing. 30 minutes or less are our webinars. Linda.
Orest, we do have one question.
Sure.
You mentioned that we're going to send out the presentation as well as the recording and the upcoming webinar on the 27th. But the third question we have is, what is the average turn time for CondoTek to complete the lender compliance report?
So on average, we run at about 12 days to 14 days to complete a lender compliance report. It depends on how quickly the documentation can be uploaded, meaning if we can get a questionnaire completed quickly or the operating documents sent over to us quickly. But on average, it's around 12 to 14 days from start to finish to get that done. Barring anything else, thank you again for joining this webinar. Again, we're so happy to be able to bring you this product. And any questions, please email sales@condotek.com. You can always email me, and I'm happy to respond to you and let you know what the process is as well. Enjoy the rest of the afternoon. It's beautiful outside here in New York. Thanks again for joining.